And of course, I'm very excited to be here. My name, first of all, is Luke, and I'm a business advisor here at Collective. And essentially, it's my job to speak to prospective collective members, see if we'd be a good fit for their business, and discuss next steps and how it would work. And essentially, Collective, you can think of us as kind of like an all-in-one solution for a self-employed person that needs to be an S corp. We'd handle, essentially the whole shebang when it comes to an S corp. So we'd set up the business for you, provide a payroll processor, take care of your bookkeeping, and then at the end of the year, file your taxes. But today we are running a session called Tax Tuesday, and essentially what it is, it's an AMA session. It's a Ask Me Anything session. Surrounding taxes, surrounding best financial practices for your business, just anything that you'd like to ask, go ahead and ask me, and I'll do my best to answer it. And just real quick to kind of get the legal stuff out of the way, this is just simply information. Don't consider this legal advice or official tax advice or anything like that. Before you take any official action on any of this information, it's always a good idea to speak to a tax attorney, a CPA. So just keep that in mind. But let's go ahead and get started because I think that we already have some clever tax questions that have rolled in. Okay. Collective. You said Collective is an S corp company. What does it mean to be an S corp? Well, that's a good question, because a lot of people, the S corp can be a little bit confusing to some people, and a lot of people have, I guess, kind of a misrepresentation about what an S corp actually is. And there's a lot of people that think that an S corp is an actual business entity. Like a lot of people think that it's an actual corporation or some sort of business entity, but it's not. It is a tax election. So it's a way to ask the federal government to tax your business, a certain way. And for one, you have to be you have to have some sort of business entity set up before you can even elect the S corp tax status. So you either have to have, an LLC set up, a corporation set up before you can even do it. But the whole reason why you'd want to do that is to save on the self-employment tax. That's the entire reason. And before you become an S corp, like if you're, just a sole proprietorship or an LLC, a big chunk of your net income is subject to the self-employment tax. The self-employment tax, it's a flat tax rate of 15.3%. So let's assume someone's net income is $100,000. And let's also assume that they're not an S corp yet. How they come up with their self-employment tax is you take 100,000 and you multiply it by 15.3%. All of that money would be subject to the tax rate when you're not an S corp. But what happens when you make an S corp election is essentially you become a W-2 employee of your own business. And since you're a W-2 employee, you pay yourself a salary. You will literally pay yourself a wage, just like you'd receive if you work for someone else, like as a W-2 employee. But the cool thing about S corps is that the only chunk of your earnings that's subject to the self-employment tax is your salary. Whatever you choose to pay yourself. So, for example, let's just assume, like I just said, that someone is netting, $100,000 in their LLC. And let's also assume with an S corp that, something like $40,000. Let's assume that's a reasonable salary for this person's, situation. How you'd come up with your self-employment tax in that situation is you'd only take the 40 grand and you'd multiply it by 15.3%. The other $60,000, or just the rest of your money, outside of your salary, Those are considered distributions to yourself. Conceptually speaking, you can kind of think of that money as dividends almost. Some people use that term. But, long story short, that chunk of money is no longer subject to the self-employment tax at all. So, in that situation, how this person would come up with their tax savings is they'd take 60,000 and they'd multiply it by 15.3%. And that right there is a tax savings of $9,180 a year in the self-employment tax. So, once a business owner reaches a certain level of income, it can be pretty advantageous to go the S corp route. All right, what are the requirements to become an S corp? Well, one is like I just said, you have to have a business entity set up, either an LLC, a partnership, a corporation. You need a business entity before you can elect the S corp status. So that's one requirement. Another requirement is you can only have up to 100 shareholders or 100 owners in the S corp. You can't have more than 100. So if you are planning on doing, like large scale fundraising to where you'll have, tons of owners in your business, the S corp election might not be, the right path for you because they have, some of those ownership restrictions on S corps. So keep that in mind. I just started a business and I haven't made any profit. Can I become an S corp? You can technically still become an S corp even if you haven't made a lot of profit. You can technically even have a loss and be an S corp. There's technically nothing wrong with that. But the thing is that when you're not making any profit yet, or if you have a loss, which means you have more expenses than you do income in a certain tax year, then essentially you're not really benefiting from becoming an S corp. Because typically the only reason why someone would, want to make an S corp election is to save on the self-employment tax. And if your net income is zero, like if you're not making much money, then you're not paying self-employment tax at all. So it wouldn't really make sense. Okay. All right. I I'm starting a gaming company and are comparing other games to my games. Can I use these purchases as a write-off? Probably not, to be honest with you, because it's a little bit complicated in areas like these because the IRS doesn't really like you writing off things that have, any sort of personal use. So you might be comparing other games, when you buy these games, but at the end of the day, the IRS would probably say you bought these games to play personally, and they probably wouldn't be crazy about you writing that off. So I would be very careful before writing stuff like that off. So to answer your question, probably not. I am a graphic designer. Can I write off my Canva subscription? Well, if you're using it for business, certainly. Um, the general rules behind an allowable business expense is that it must be ordinary and necessary in your course of business. So a Canva subscription for a graphic designer could very well be ordinary and necessary, for your business. Okay. Ooh, here's a good question. Can work attire for a particular event be written off as a business expense? Well, it depends on how specific that work attire is. Now, if it's some sort of like specific uniform or something like that that's required for your career, that's a little bit different. Like that could be a write-off expense. But just usually just buying a nice piece of clothing for a work event is usually not a deductible expense. It's usually not because you're gonna wear that personally. You happen to be wearing a personal piece of clothing to a work event. That's usually how the IRS sees it, unfortunately. Alex has a good question. When is it a good idea for a C corp to elect for an S corp taxation? Um, well, it just kind of depends. I mean, if you're just a single member, if you're just kind of like a small business owner and you don't plan on fundraising or having tons of owners in your business or anything like that, then yeah, if you have a C corp, then I would probably, set up an S corp or make an S corp election as soon as you can. Because also keep in mind that if you form a corporation and you stay a C corp and you don't make the S corp election, you typically have double taxation in a sense to where the corporation itself gets taxed, and then you, as a shareholder of the corporation or an employee of the corporation, gets taxed on income. And with an S corp election, you go back to kind of like a pass through tax structure. So keep that in mind. You might not need to be a C corp, but just like with everything else with taxes, these are very complicated, and it just kind of depends on your personal situation. Can you give examples, please? I'm guessing, examples of business expenses? I mean, really anything that you're spending on the business for the business that's ordinary and necessary is a business expense. So, marketing cost. Maybe you're hiring a marketing consultant to help, market your business. That should be an allowable expense. Um, any sort of mileage that is specifically for business, that's typically allowable. Um, you can take the home office deduction to where if you work from home and you can write off a portion of your mortgage interest or rent, and utilities, things like that. So there's several things that you can write off from your business. And also in certain situations, you can do things like um, you know running health insurance through the business. There are certain situations where you can write off health insurance premiums. There's great things you can do with self-employed retirement accounts. So when you're self-employed, there's several strategies you can put in place to save on taxes and optimize your finances. When are meals 100% deductible if I'm a 1099 employee? It would be very rare for a meal to be 100% deductible. Now, I believe, and to be honest with you, I'm a little bit rusty on the rules, but I believe that you can only write off, if a meal is specifically for business, I believe that you can only write off 50% of it. But again, to be honest with you, I need to brush up on the rules. I'm not really sure if that's correct. So research that before you put that into practice. Okay, so this is kind of generally how it works with meals. So business meals are eligible for a 50% tax deduction. So essentially, you can deduct half the bill next time you treat a client to dinner or anything like that. So I want to yeah I want to say in most situations it's 50% if it's an allowable meal, an actual meal for business. Um, And unfortunately, this stuff can just get really complicated and complex, and it's the US tax code, unfortunately. Can I write off things like books? Well, it depends on what those books are. I mean, books, that's a pretty wide category there. Now, if you have books, let's say that you're buying books for the business. Like let's say that you're buying, informational books on how to run your business or marketing books or sure, there's no reason why there's no reason I can see why that wouldn't be a deductible expense. But just personal books that you write off for your own enjoyment, no, those typically aren't an allowable expense. How should one calculate a salary paid to oneself during year one? In other words, while still building up business funds and unsure what the annual income will be. If you're really unsure what your annual income will be, it might be a good idea to kind of hold off on the S corp election just to kind of see how much money you make, and see if it would be worth it to go the S corp route. And what collectives, and this is a collective number specifically, what we say is we say if you expect to if you expect to net, and when I say net, I mean, after your business expenses and everything like that, if you expect to net around $60,000 in a 12-month time period, that's when we say it's worth it to go the collect or to join collective and become an S corp. And essentially, that's because this is very general and it doesn't always happen this way. But if someone is making at least $60,000, then it's likely that the amount that they'd save in taxes with the S corp would overtake collective's fee for the year. So that's kind of like a good rule of thumb. So if you have no idea, what your annual income will be, it might, be a good idea to hold off on the S corp, see how much money you make this year, and then maybe become an S corp for 2025. But to answer your question a little bit further, what you can do, because with the salary needs to be reasonable. That's what the IRS says about it. And a tax professional can kind of help you choose a salary and run a salary analysis. But typically, a good rule of thumb, and again, this is just a rule of thumb, this isn't exact or any sort of objective measure, but there is a rule of thumb to where if you're at around 40% of net income, that's kind of like a rule of thumb for a salary and a number that you can use for example purposes. So just keep that in mind. What can I do to keep track of my expenses year over year? Well, for one, um, of course, I'm a little biased by saying this, but to become a member of Collective, that's one. Because really, what Collective does is not only handle the compliance issues with the S corp and getting the S corp set up, but ongoing payroll and bookkeeping as well. So if you come on board with us, you won't have to worry about keeping track of your expenses year over year. But if you're doing it yourself, it's usually a good idea to get an accounting software. Some sort of online accounting software that kind of automatically, tracks your expenses and everything like that. So that's the best way to do it is get an accounting software and, save your reports, save your profit and loss statements. Um, and that's what I would do. All right. Why can't I pay myself a really low salary and take the rest out in distributions? Well, well, I get that question asked to me a lot. And the question is, well, if I'm only subject to the self-employment tax on my salary, then, why not just pay myself, a super low salary, like, a dollar or something like that, and then take out the rest in distributions? And my response is because it that would increase the likelihood that you got audited, you know, because the IRS, what they say about the salary is that the salary has to be a reasonable amount. So if you're making $100,000 and you paid yourself a dollar in salary, then they would very likely deem that unreasonable, and they could audit you and penalize you, and have you pay back your back self-employment taxes that they think that you owe. Can you break down the difference between an S corp, a C corp, a sole proprietorship? Which should I choose? Well, sure. So this is kind of the idea behind all this stuff. For one, think of the S corp in kind of a separate camp as LLCs or corporations or sole proprietorships or business entities. Think of it as something different. Because, for example, let's say that if you don't set up any sort of business entity, you're a sole proprietorship. The IRS considers you a sole proprietorship. Let's say that you set up an LLC. You have a business entity that's in existence, but tax wise, the IRS considers you a disregarded entity for tax purposes, meaning there is no entity taxes and you're just taxed like a sole proprietorship is in the IRS's eyes. Now, if you set up a corporation, a C corp, you now are taxed as a corporation in the IRS's eyes automatically. And what that means is you are subject to double taxation typically, meaning part of your income is taxed at the corporate level, and then the other part is taxed at the investor level and employee level. What happens with an S corp election is you can change your tax structure on both the LLC situation and a C corp situation. And with an LLC, what it does is it saves the amount that you pay in self-employment tax. That's what happens with an LLC. When you make an S corp election on a corporation, it essentially converts it into a pass-through tax structure again, to where you're still a corporation, but all of your income just passes through to your personal tax return. Um, and in terms of which one you should choose, it's extremely confusing, because it kind of depends on, what stage of the business you're in, how much money you're making, how much or like what are your plans with, business ownership, how many owners you're going to have in your business. There's just several things to consider when you're trying to figure out what sort of business and tax structure is good for you. And Collective, what we offer is free consultations before you even join, to kind of go through if an S corp, would potentially even be a good fit for you, if Collective would be a good fit for you, and if we determine that it's not, we give you referrals and point you to someone that could handle your situation better. But it's always a good idea to speak to a tax professional before you set up any sort of business entities. Okay. I think we've got more questions rolling. Okay, here's a good question. In what situations would you want to be a C corp over an S corp? Well, for one, a big one for that is if you expect to have more than 100 owners in your business. Like I mentioned earlier, the S corp election puts a limitation on kind of the ownership structure of a business, and that you can only have up to 100 shareholders in an S corp. But with a C corp, you can essentially have an unlimited amount of shareholders. So there's just certain industries and different situations that aren't good, for the S corp election. Okay. Do you have an extra tax return when you have an S corp? Yes, you do. So before you're an S corp, let's say that you're just a sole proprietorship or an LLC or something like that. Then you only have one tax return. You have your personal tax return, and all of your business information and write-offs and all of that goes on your personal tax return on your Schedule C when you file your return. But when you make an S corp election, you have a business return that comes into existence, and that one is it's called an 1120S. It's an S corp tax return, and that one's due by March 15th of every year. It's due before the personal return, and then after you get the S corp tax return filed, there should be a document called a K1 form that's issued, and that K1 form has just a few pieces of information on your S corp return that you'll then use to input on your personal tax return. So, when you're an S corp, the personal return becomes, pretty straightforward in filing usually. All right. I think I have time for one more insightful tax question before I have to hop off here. You mentioned earlier that $60,000 was the sweet spot for collective and an S corp. Why is that? Well, and again, what I'm getting ready to say, these are very general numbers. Like it doesn't apply to everyone, and your situation could be different. But very generally, when someone is making or netting around $60,000 in their business, they're generally saving around $5,500 a year in the self-employment tax. That right there is, especially on an annual basis, that overtakes collective's fee, meaning you save more in the self-employment tax than what you pay collective. So we just kind of give a general rule of thumb to where if you expect to be making at least 60,000, you can generally expect to save more than what you pay collective. But unfortunately, that's all the time that I have left today. I actually have to run and speak to a prospective collective member. But it was a pleasure, and I hope that this session was valuable to you, and I hope you learned more about S corps. And I'll be here next week for another Tax Tuesday. But in the meantime, if you think that an S corp or collective might be a good fit for your business, please feel free to schedule a call with us, and we'll talk it through with you. But until next time, I will see you next week.